Did you know that the average investor underperforms the stock market by about 1.5% every year? Sounds crazy, right? In fact, studies show that 85% of investors miss out on the long-term returns of value stocks because they're chasing quick profits or following the crowd. The secret to winning in the market isn't about picking the hottest stocks. It's about investing in solid companies at the right price and holding them for the long run. Over the next 2 hours, we're going to dive into 30 years of business knowledge, covering the essential strategies that the world's most successful investors use to build wealth. We'll break down the basics of value investing, uncover hidden gems, and show you how to spot opportunities that most people completely overlook. This isn't about trends or gimmicks, it's about smart, long-term decisions that can make a real difference to your portfolio. You'll learn how to read financials beyond the surface, spot economic moats that protect companies from competitors, and most importantly, how to find value in a world obsessed with growth. By the end of this video, you'll have a toolbox full of strategies that you can start using right away to become a more confident, smarter investor. Get ready to transform the way you think about investing. Chapter 1. The Art of Patience. Why timing is everything, but not right now. Patience is often the hardest lesson for investors to learn. Warren Buffett, one of the greatest investors of all time, once said, "The stock market is a device for transferring money from the impatient to the patient." Value investing isn't about chasing the latest trend or making a quick profit. It's about waiting for the right opportunity at the right price. A great example is Coca-Cola, which Buffett invested in during the 1980s. At the time, the stock was undervalued, but the company took years to show its full potential. Patience in investing is a long game, and it's crucial to avoid reacting to daily market fluctuations. For example, the 2008 financial crisis was a disaster for many, but for those who stayed patient, it was a golden opportunity. A research paper from Morningstar found that the average annual return of value stocks from 1927 to 2020 was 11.2%, compared to growth stocks at 9.3%. Value investing has historically outperformed over the long run, but only if investors have the patience to wait. The key is recognizing that great investments don't necessarily produce instant results. Businesses need time to unlock their potential. Timing the market is almost impossible. The right strategy? Timing the purchase. Chapter 2. The silent metrics. 5 key signals the pros watch closely. When it comes to value investing, the most successful investors pay attention to more than just the basics. While many focus on earnings per share, EPS, and price to earnings, P/E, ratios, seasoned investors know to dig deeper. For example, when assessing a company, one must pay attention to its return on equity, ROE, which shows how effectively the company uses shareholders' money to generate profit. A higher ROE usually signals a more efficient and profitable business. Another important metric is free cash flow. This is the money a company has left after paying for operating expenses and capital expenditures. Free cash flow can be a better indicator of long-term value than reported earnings, as it shows a company's ability to fund future growth without relying on external financing. Customer retention rate is another silent metric many investors overlook. Companies that maintain loyal customers tend to be more stable in the long run, especially during tough economic times. And don't forget management quality. Legendary investor Peter Lynch always emphasized that one of the most critical factors in value investing is the quality of the company's leadership. If the management can clearly articulate the business's strategy and has a proven track record, that's a sign of potential long-term success. Lastly, a low debt-to-equity ratio tells you a lot about how a company is managing its financial risks. Low debt means the business is not overly reliant on borrowing, which makes it more resilient in times of economic uncertainty. These silent metrics can help investors uncover value that others might miss. Chapter 3. Hidden Giants. The underrated stocks you're overlooking. Undervalued stocks are often hiding in plain sight. Many investors flock to well-known companies, but there are small, niche businesses that are full of potential. Look at companies like Roku, which was a relatively unknown player in the streaming space a decade ago. Now, it dominates a growing market and has exploded in value. Value investors know that sometimes it's the small-cap stocks, or even micro-cap stocks, that hold the best opportunities. According to a 2020 study by Dimensional Fund Advisors, small-cap stocks have historically outperformed large-cap stocks over long periods. Yet, many investors overlook these opportunities because they're not on the radar of the mainstream. Hidden gems often have strong brand loyalty, a steady cash flow, and a unique product or service that sets them apart. For example, Lululemon was once considered a niche brand but has since grown into a market leader. Finding these hidden giants requires looking beyond the headlines. It's about uncovering companies that might not be in the spotlight yet but have strong fundamentals, untapped markets, and a solid growth trajectory. With the right research, these businesses can yield massive returns. Don't forget to subscribe so you won't miss out on more tips to sharpen your investment strategy. Chapter 4. The Dark Side of Growth. Why growth doesn't equal value. The pursuit of high-growth stocks is tempting, but it's important to remember that growth doesn't always equal value. Many investors believe that fast-growing companies will automatically lead to high returns. However, this assumption often leads them into growth traps. Take a look at the dot-com bubble of the early 2000s. Investors flocked to companies like Pets.com, which had no clear path to profitability. These companies had high growth but were overvalued and unsustainable. A report from Yale University showed that growth stocks tend to have higher volatility and lower long-term returns than value stocks. As Buffett has often pointed out, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. While high-growth companies might seem attractive, they often come with high valuations, making them risky investments. In contrast, value investors focus on companies that are undervalued relative to their intrinsic worth. These companies may not have the fastest growth, but their stock prices are generally more stable and reflect a more reliable future. It's not about picking the next unicorn, it's about choosing companies that are consistently undervalued. Chapter 5. Economic moats. The superpower that keeps giving. An economic moat is a term coined by Warren Buffett, and it's one of the most important concepts in value investing. A moat is essentially a company's competitive advantage, something that protects it from the competition. The stronger the moat, the more a company can fend off competitors and maintain profits over the long term. Buffett is famous for investing in companies with strong moats, like Coca-Cola. The company's brand is a huge barrier to entry for any new competitors. Similarly, Apple's ecosystem, its operating system, apps, and hardware, creates a moat that keeps customers loyal. There are various types of moats: brand loyalty, network effects, cost advantages, and regulatory advantages. For instance, Amazon's massive distribution network and pricing power create a formidable cost advantage. Visa benefits from the global network of cardholders, creating a strong network effect. By identifying companies with strong moats, value investors can choose businesses with a higher probability of long-term success. The economic moat helps ensure that the company's profits will keep flowing for years to come, even during economic downturns. Chapter 6. Navigating the dark matter. Understanding the unknown risks in investing. Even the most experienced investors can miss hidden risks. These dark matter risks are often not visible in the financial statements but can have a significant impact on the company's future. Geopolitical risks are a prime example. Trade wars, political instability, and regulatory changes can dramatically affect global companies. Take the example of Huawei, a Chinese tech giant that faced major disruptions due to international trade policies. Even though the company's financials were strong, these unseen risks created massive volatility. Another overlooked risk is technological disruption. While many focus on a company's current performance, few realize that the next wave of innovation could render a company obsolete. Blockbuster failed to see the potential of streaming and was overtaken by Netflix. Being aware of these technological threats can help investors avoid falling into the trap of holding onto a sinking ship. Lastly, investors must account for environmental and social factors that could impact a company's reputation or operational costs. As the world shifts towards sustainability, companies that fail to adapt could see their stock prices plummet. By identifying these hidden risks, value investors can better assess a company's long-term viability. The key is not just focusing on the company's performance today, but on how external forces might affect its future. If you found these tips helpful, don't forget to subscribe and stay tuned for more value investing strategies to boost your financial future.